Welcome to TheoTrade. This is Don Kaufman. Here we are. It's October 5th, 2016, doing the Theo Night video. The market has got about 4 minutes left to play in the period, and we're going to start off this evening talking about levels. Now, this is something I've discussed extensively over the last several weeks, and again, very definitive levels. Each day that we're walking in to trade, you have to look at it as nothing more than a binary event to specific levels. Now, what that ultimately means is every day, reset the clock, get away from any bias that you might have in the market. Like, you got to step back and, on a day-to-day basis here, don't walk in and be, I'm bullish, I'm bearish. Sure, you can have a longer duration stance on the market. For example, I am bearish, and I am bearish. I'm short markets right now, but that's a more duration perspective. On a day-to-day basis, and I do trade intraday, and I trade for mid-duration, and one of the things I just cannot stress enough is you got to walk in, knock the chip off your shoulder, and just realize that we're trading from level to level. Now, what are those levels, and how did I ultimately decipher some of the levels is what we're going to look at. Number one level that you're looking at on your screen over here is 2153. 2153, and that is to the S&P futures. So I want to be very, very clear. What you're looking at is a 30-day 1-hour chart, 2153. It has been like the vortex of trade. By the way, to be frank with you, it's just not over the last 30 days. You can actually back up and look back. All right, if you want to get crazy with it, you can even go back 90 days with this, and you'll actually see how much trade has persisted at this 2153 level. Again, you're going back here into early July time frame, and we're still sitting on that particular range. So again, one of the primary areas to be concerned with, of course, is this level of 2153. Right down below it, we've seen a tremendous amount of hedging activity persistent at 2143, exactly 10 points. Now, when I talk about levels and getting drawn into them, you can't think, all right, in that old, I guess, school methodology of support and resistance. The levels that I'm looking at and establishing are much more in relation to where I'm seeing tremendous hedging activity. And how do I look at hedging activity? Right, so futures drive order flow to the marketplace. And if you look at futures and you go all the way down to a 1-minute chart, you'll actually see hedging activity. And it's pretty transparent when you see hedging activity taking place. Very, very large spikes in volume down to a 1-minute candle. And again, the line on your screen is literally 2153. So obviously keep that one in mind. It's where we've seen this just tremendous amount of activity and persistent. We just keep getting drawn back to literally 2153 on the button. Now we've seen some of that activity at 2143. More or less, you want to keep that in mind. It's not, though, one of the key threshold levels. The next one down on your list over here, once again, is 2129. Now these are levels that I mentioned weeks ago, literally weeks ago. Mentioned them again, about 2 weeks ago. But 2129, then very, very key level of 2112, where we actually bounced off of, and ripped higher a number of times. Again, 2112. And last but not least, and this is, again, it's not one of the key levels, but I put 2100 even on there because that's where we touched down to in some of the volatility from early September. So on a day-to-day basis, when you walk in, assume that you don't know anything. It's a coin flip away. Order flow starts to ultimately play out. And again, we'll go look at some of the trade today. If you take a look at the trade, including overnight, what did we do? Well, we came right off this 2143 level. I mean, to a T, we came off the 2143, came up, there's the bell, came up to 2153, substantiated for a while, floated higher, and we closed basically where 2153 on the button. And this is all that we've seen in recent trade. And again, you have to sometimes zoom out from like the intraday trade. And this 30-day 1 hour has done us some justice lately. We're just trading from level to level. again, look at this 21.53 not a support and resistance. Look at it as kind of this inflection point. It's the crossroads of trade right now, and that's because that is where ultimately this ball of risk lies. Okay, so why am I mentioning this? Hey, there's not a good directional feel, because there's a lot, all right, of news coming out this Thursday, this Friday that could spark quite a bit of volatility. And in the midst of volatility, you better be really comfortable accepting a multitude of levels. Now, here's where I give you a little bit of a projection. We have not come down and tested into this 21.29 at all in the last 2 weeks. I fully expect some volatility Thursday, Friday this week. I would look towards the 21.29 handle in the S&P futures to be tested. What am I ultimately basing that on? Okay, there are weakness in a few major technology stocks. What really held the market together today was specific. It was the financials. Okay, I'm looking at the XLF over here, but the financials, they're strong today. They actually held markets up along with energy. Okay, however, if you took a look at the titans of technology, were they strong today? Not necessarily so. Facebook, all right, really mellow day. Up, 0.2%, couldn't get out of its own way most of the trading session. Apple ends up massively unchanged on the trading day, dead. Okay, we're seeing a little bit of weakness inside of Google. Now, granted, Amazon, it's strong. Yeah, but Amazon, in terms of market cap, is not going to be enough to outweigh the forces of Google, Apple, Facebook, okay, which are the behemoths that are really driving a tremendous amount of order flow back to the S&P futures and back to the NASDAQ futures. Keep your eye on those technology stocks in the next 2 days, because again, the NASDAQ, all right, it did, fair today, but was weak versus the S&P. And again, those S&P is driven by financials and driven by none other than the XLE energy sector. Last but not least, I want to talk just briefly about gold. Now, this is not exactly going to be leaving here on the Theo Night video on an up note, but I want to talk about gold because I've just had this inordinate number of questions about gold. Now, you may not trade the gold futures. Maybe you trade something like GLD, okay, which is fine. It's whatever you're comfortable with. I'll throw GLD in here. Just pull up the chart on GLD, which is just a gap-filled wonderland. I want to give kind of a stern warning to everybody that is looking at gold. And I know all the gold, the gold nuts, they're out. What does that mean? I mean, all these gold bugs are just touting it. Oh, you got to buy it now. Come on, gold, it's backing off into the 1200. Buy it before the election comes out. There's one issue with that. What are you really trying to do? Getting long or short gold? Okay? And I know that sounds, easy enough. Well, if the world collapses, I'll be in gold. Or if markets are going to tank, I'll be in gold. But there's a big issue that I have with that. Okay? And that's the very premise to which gold is trading right now. So if you take a look at the gold futures themselves, which they're off pretty big over here. Are the gold futures off big? Or is it that the dollar has just gotten incredibly strong lately? Okay, there's this great inverted relationship over there. And one of the issues that you're going to face if you're trying to trade gold is a bet in the currencies. And right now, when you think about currencies, what's going on inside of the British pound? It's getting pounded. I've been waiting days to say that, right? British pound is obviously getting slaughtered out there. Even the yen has backed off lately. And you have to think to yourself, if you're going to be buying gold, if the markets do tank, okay, around the world, if we're going to hit patches of extreme volatility, for one, I'm not so sure that gold is going to be a spectacular hedge. And I'll give you specifics as to why. And this is what, again, people just tout gold. It's at this critical level over here. Forget it. It's a currency trade at this point. And I think it's a dangerous currency trade because in the end, okay, if markets do start to tank, and traders, being what they do, get nervous. What are they going to do? They're going to dive into bonds? No. Bonds are an overcooked turkey, right? And bonds, they happen to be backing off a lot lately. Okay? Where are they going to dive into? Well, in the end, when it comes down to it, currency. And what currency? Whoa, well, you want to go over into buy the Chinese currency? No. You want to go buy the yen? No, because that's scary because there's all kinds of crazy central bank going on over there. You want to go buy the euro? No, I'm not too comfortable with the euro. What about the pound? Oh, yeah, that's going to be good and fun. Because coming into March of 2017, they'll officially be getting the boot. They booted themselves. Okay, but the Brexit will be official. What do you think they're going to do? They're going to go in and they're going to buy, okay, the dollar. And if the dollar does take off, because the dollar is just, stone's throw off of all-time highs. The dollar does take off to the upside. The impact to gold, I don't think it's going to be pretty. And I'll tell you right now, I'm not willing to take that bet inside of gold unless you do some type of defined risk trade. Think about it. So for the next 2 days, got to be thinking about the levels in the S&Ps because the S&Ps are going to drive order flow to the whole marketplace. And again, if you are going to be involved in a gold trade, just be aware of what you're really trading out there. This isn't some technical breakout or breakdown. It's a currency trade. Thanks, everybody, for joining us here at TheoTrade. Have a great evening. Bye-bye.